Let us do the exercise for topic 6. Exercise 1. Let's read the question. The following information relates to 3 possible capital expenditure projects. Because of capital reasoning, only one project can be accepted. So we have project A, B, and C. So this is the initial cost, useful life, service value expected, expected cash inflows for year 1 until year 5. The company estimates its cost of capital is 18% and discount factors are for year 1, year 2, 3, 4, and 5. So the requirement, calculate the payback period, calculate the accounting rate of return, calculate the net present value of each project, which project should be accepted, give reason, explain the factors management would need to consider in addition to financial factors before making a final decisions on a project. So let's see the answer. Okay, for the payback period, for project A, B, and C, for year 1, okay, all the information is given in the in the questions. Just put back and from year 1 until year 4, and then the payback period for project A equal to 2.77 years. For project B, 3.2 years. For project C, 2.65 years. So which project is the best? So will be the lowest project, okay, according to payback period. Okay, for B, the accounting rate of return for each project, accounting rate of returns equal to average profit divided by initial investment. Okay, so average profit equal to average annual cash inflow minus average annual depreciation. So first we calculate the average annual cash inflow, that is total cash inflow divided by useful life. So for project A, we put all these informations that is given in the question, we divide by the useful life. So we get the answer 66, and for project B 64, and for project C 78.75k, right? So average annual depreciation equal to initial investment minus average value, and then divide by useful life. Okay, so for project A we get 38k, for project B 43k, and for project C 43k. Average profits equal to average annual cash inflow minus average annual depreciation. So whatever we calculate earlier, 66k and 38k, 66k and 38k. So we got the project A 28k, project B 21k, and project C 36.75k. So the accounting rate of return, that is average profit divided by initial investments. So we get 14% for project A and 9.13% for project B and 19.86% for project C. Okay, or you also can do like this. Alright, so see the net present value of each project. Project A year 0, okay, we put the initial amount, and then for year 1 until year 5, so the inflows and the discount factors, and you will get the NPV for each, right? So the cash inflows plus average value equal to 55k plus 10k equal to 65k, right? For this one, this is the calculation for year 5, right? So for the project B, it will be the same way. So you have to calculate all the information, the figures given, and you'll get the NPVs of 10.385k negative. Okay, for project C, you will get NPV 26.838. So D, which project should be accepted and give reasons. Okay, we already calculated earlier. The NPV methods of evaluation is superior to other methods, and the project with the largest NPV ought to be selected. That is project C. It should be noted that project C is also referred to A and B when payback and accounting rate of return methods are used. So based on our calculation just now, you make a decision and give your reasoning. E. Explain the factors management would need to consider in addition to the financial factors. So beside financial factors, there are other qualitative factors that need to be considered, such as the impact on existing sales, the effect on employees, and the effects on environment from each of the 3 projects. In addition, the risk and reliability of the cash flows for each project should also be considered. Okay, so that is for chapter 1, exercise 1, and we go to exercise 2. So let's read the question. Sinta Sdn Bhd is considering a project that would have a 10-year life and would require a 1.2 million investment in equipment. At the end of 10 years, the project would terminate and the equipment will have no salvage value. The project would provide no operating income each year as follows. Okay, the project would provide net operating income each year as follows. So, giving you all the informations, okay, sales, variable expenses, contribution margin, and all the expenses here. And the net operating income after tax is 180k. The company's required rate of return is 12%. So you are required to compute the project net present value, project internal rate of return, project payback period, and project accounting rate of return. So, okay, the answer for exercise 2, right, first one, since the depreciation is the only non-cash item on the income statement, the annual after-tax cash inflow can be computed by adding back depreciation to net operating income. So we adding back the depreciation, we get the annual after-tax cash inflows of 300k. Or you can calculate it like this. So okay. Right. So for net present value, the initial investment is 1.2 millions. Okay, the interest factors, and then the annual after tax cash inflow from 1 to 10 years. Okay, 300,000. So this is the interest factors. Okay, and you get the amount, and the net present value is 495k. Right. So for IRR, okay, the formula for computing the factors of the internal rate of return is investment required divided by annual after tax cash inflow equal to the factor of IRR. So we put all the numbers and we get 4 factors. Okay, if you want to the nearest internal rate of return, okay, the answer is 21. So how you get it? Okay, 4 factors. 4 factors for 10 years. Okay, 10 years. Okay, you look at the 4 factors. Okay, 4 factors. The nearest is 4.064 here. Okay, so when you look up, it is actually 21%. Right. So C for payback period, investment required divided by annual after tax cash inflow. So we get 4 years. Okay, for accounting rate of return, average annual after tax net operating income divided by initial investments. So we put the figures and we get 15%. Okay. Okay. Exercise 3. Okay, exercise 3. Under a special licensing arrangement, Vineyard Company has an opportunity to market a new product for a 5-year period. The product would be purchased from the manufacturer with Sunyard Company responsible for promotion and distribution costs. The licensing arrangement could be renewed at the end of the 5-year period. After careful study, when your company estimated the following costs and revenues for the new product. So this is the cost of equipment, working capital needed, overhaul of the equipment in 4 years, service values, and then annual revenues and costs, the sales revenues, the cost of goods sold, operating costs. Okay. At the end of the 5-year period, if Sunyard decide not to renew the licensing arrangement, the working capital would be released for investment as well. Singward Company uses a 14% discount rate. Would you recommend the new product? So let's see. So sales revenue, less cost of goods sold, less operating cost, and get the annual net cash inflows. So annual cash net flow, okay, we calculate here. Purchase of equipment is 60k. Working capital needed is 100k. Overhaul of equipment 5k. Annual net cash inflow we calculated earlier 40k. Salvage values on the equipment 10k, and working capital release 100k. So we get the NPV of 31.45